Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern every Monday morning. Get you ready for the week. Stocks to watch, economic news to highlight. Showed you last week how to use that PEG ratio, that price to earnings to growth ratio, to really evaluate those growth stocks on a value basis, factoring in that super fast growth and helping to reason kind of how value investors can still play some of these growth stocks. Even accounting for that expected growth of 67% annual in earnings though, NVIDIA was still just way more than I'm ready to pay at a 1.98 times PEG ratio. I usually look for that 1.0 or less or right around there for these growth stocks, and that is just way too much. But there is no doubt that AI is going to revolutionize our lives, and I don't want you missing out on that theme just because the market darling is so expensive. So I went looking for the top AI stocks trading less expensively than NVIDIA. I'm going to highlight the top 5, then show you the PEG ratio for all 14 most popular AI stocks. Stick around after that and we'll do our market update, all the stocks I'm watching this week, and the economic news you need to see. Before that, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, click on the link I'll leave in the description below. It's a free report I put together with the Motley Fool. In it, you'll find those long-term, trillion-dollar themes like artificial intelligence, EV stocks, and green technology that are going to be here for decades, and the 5 stocks that are going to benefit from those trends. It's all totally free. Just click on the link I'll leave in the description below and get your free report. I want to get to those cheap AI stocks, but understand a couple of things here. First, AI stocks are definitely in a bubble. Okay, that's not saying that the next 5 or 10 years these stocks won't be higher up in price, but could easily be much lower over the next year or two. Now, we can talk valuations all day, but the fact is when everyone is talking about one particular theme or trend in the market, there's a good chance that is in bubble territory already. But that does not mean you shouldn't invest in these stocks. If you still want to invest in AI stocks, it just means you need a plan for regularly investing every few months or even every year. That way, if the bubble does pop, you're going to be able to buy shares in that lower cost and get that lower average cost on your shares and still be in the stock when it takes off again. Another thing to understand, something we talked about last week and we'll go over again in this week's video, is that PEG ratio, the price to earnings to growth, is very much dependent on those estimates for earnings growth. So again, the price to earnings to growth ratio is just the PE ratio, the price to earnings, so the price of the stock divided by the earnings they've made over the last 12 months. Here we can see NVIDIA is a price of $393, and the earnings over the last 12 months have been $3.34. So if we take the stock price, $393, divided by $3.34, we get a price to earnings ratio of 117 times. Now that is terrifically expensive, and I don't think anybody can rationalize buying a stock at 117 times its earnings. But if you use the PEG ratio, that accounts for that supernormal growth. Price to earnings to growth. So price to earnings ratio divided by the growth rate in the shares. So here through 2025, we can see analysts on Wall Street expect NVIDIA to post earnings of $9.67 a share in 2025. If we want to get the growth rate for that, that is $9.67 divided by the last 12 months of $3.34. That is 2.89. Now that's 2 years, so we got to do 0.5 here. That is a 70% growth rate in earnings, 70% growth annualized each year. So what we do, we take that price to earnings ratio of 117 times divided by 70%, just divided by 70 there. And that gives us our PEG ratio. Oops, divided by 70. That gives us 1.67 times price to earnings to growth ratio. So 2 things there. First, you got to be able to believe that NVIDIA is going to post a 70% earnings growth over the next 2 years to that $9.34. That is a little suspect because it is very fast, very high earnings growth. Second, though, you got to understand that that price to earnings to growth ratio is going to change as those estimates for earnings change. Okay, just last week, we saw analysts expecting just a 67% earnings growth over the next 2 years for NVIDIA. So that has come up. Wall Street analysts are getting more and more optimistic about the stock and more and more enthusiastic about those earnings growth. So that is increasing the earnings growth estimate and then decreasing the PEG ratio. So now NVIDIA not quite as expensive as it was just last week, supposedly. So that 1.67, that's still pretty expensive. So I still want to look at some of those stocks that are maybe a little less expensive than NVIDIA. First on our list here, few have benefited from the AI theme quite as much as Palantir Technologies, PLTR. Its shares are up 130% this year. Now, the company has reached profitability this year and is expected to grow earnings by 104% annually through next year. We can see that again through the analysis tab here on Yahoo Finance. You can get this on any brokerage platform, but this is a free resource, so I love showing this to investors how to use this. So if we look at 25 cents expected earnings there over the next 2 years, earnings of just 6 cents a share over the last year. So what we're going to do to find that earnings growth rate, 0.25 divided by 0.06. So that's next year's earnings divided by last year's earnings. It's going to equal 4.16. And then you take that x to the y, 0.5. That gives you your annualized amount minus the 1 is going to give you 104%. They're expected to double their earnings each year over the next 2 years. 104% earnings growth there over the next 2 years. If we take the price of $14.52 a share divided by their last year's earnings of 0.06, 6 cents a share, we get 242 times price to earnings ratio. Again, ridiculously expensive on a price to earnings ratio, but they are growing those earnings by a ridiculous speed. So 242 divided by that 104%, gives us a 2.32 times PEG ratio. So here we see shares of Palantir are more expensive on that PEG ratio than NVIDIA. When I looked at this data last week before that big bump in expected earnings for NVIDIA, as well as before the big bump in shares for Palantir, Palantir was actually trading less expensively than NVIDIA. So that just shows you how these PEG ratios can change depending on the price of the shares, the earnings expected for each different stock. So Palantir here, even more expensive at almost 2.4 times on a price to earnings to growth ratio. Here we do start getting into the AI stocks cheaper than NVIDIA though. Here shares of Alphabet, ticker GOOG, come in just under NVIDIA's price in terms of PEG ratio. We can go here again to the analysis. I'm going to show you one more time how to calculate these to show you that PEG ratio. And we can see here that analysts expect Google to report earnings per share of $6.24 there through 2024. That would be compared to $4.56 in earnings there in 2022, a year ago EPS over the last year. So if we take that $6.24 expected earnings in next year divided by $4.56 last year, then we're going to do x to the y, 0.5, since it's 2 years, since it's a 2-year time period, and then minus the 1. That gives us 17% annualized earnings growth. 17% annualized earnings growth expected for Google, for shares of Alphabet over the next 2 years. And then we go here, we find the price to earnings, $125 price of the stock right now, divided by that $4.56 in earnings that they reported. Going to give us a 27.4 times PE ratio. So 27.4 divided by that 17 times earnings expected growth rate is going to give us a 1.61 times PEG ratio. So shares of Alphabet trading for a 1.61 times PEG ratio, still a little expensive, but cheaper than some of those AI stocks like Palantir, like NVIDIA. Now, these shares suffered initially on that chat GPT rollout and really worried investors that Microsoft might take some of Google's coveted search ranking position, but investors have come back and pushed the stock higher. Now, I like Google just not only on its search dominance in search, its YouTube, but also its other investments in self-driving through Waymo, through healthcare that could really pay off big in the future. One of the stocks you'll actually see in that free report, one of my forever stocks, Salesforce Inc., ticker CRM. Been holding this stock since 2016. It's paid off great. I think this has a great future. Sold off on its earnings report last week, but this software company still stands to benefit big from that AI, and especially AI in enterprise services. And analysts are expecting 31% sales growth over the next 2 years. So very strong sales growth expected for this company. That brings that 40.4 times PE ratio, very expensive on a PE basis, into a more reasonable territory with about 1.3 times PEG ratio. Another stock I own, and though the stock did jump late last week, the China reopening play has completely faded, and shares of Alibaba, ticker BABA, are down for the year. Now that already puts them in value territory with a PE ratio of just 11 times earnings, but with a 10% plus expected earnings growth over the next 2 years, That brings the PEG ratio down to just 1.1 times. That is very much closer to that 1.0 times PEG ratio that I look for in these growth stocks. Signals very good value in these. Now, besides just an increase in general Chinese consumption that's eventually going to take these shares higher, the company is working on its own AI products and is soon going to start spinning off a lot of its segments to investors. So could be some very strong investor sentiment increase in this stock. When we see that same low valuation trend in Chinese stocks here, it shows us the cheapest AI stock here with JD.com, ticker JD. It's 15.7% expected earnings growth over the next 2 years and a 13.8 times PE ratio. Again, so a 13.8 divided by 15.7, that gives us a PEG ratio of just 0.88 times. So any PEG ratio you can find that is below 1.0 is something you want to watch. The company has unveiled its plans for a chat GPT style AI tool to power its e-commerce site, though the shares haven't taken off like a lot of those other AI stocks. Now, if you didn't see your favorite AI stock in this list of least expensive, that could tell you something. When the PEG ratios of the least expensive approach 2 times, that's a clue to know that really how expensive this theme really is getting. But I wanted to show you some of these other popular AI stocks, the PEG ratios, just to show you how expensive this theme really is. Here we see Microsoft, ticker MSFT, at 4.04 times on a price to earnings to growth. Tesla, ticker TSLA, Kathy Wood's big AI investment here, 5.4 times. Broadcom, ticker AVGO, 2.74, a little bit less expensive than some of them. Advanced Micro Devices, big chip maker there, AMD, 3.98 times. International Business Machines, ticker IBM, trading for 2.95 times on a price to earnings to growth ratio. And Marvel Technology, ticker MRVL, trading for 5.3 times on that price to earnings to growth. Now, the price to earnings to growth ratio for Amazon and C3.ai, ticker AI, there couldn't be computed because they have negative earnings growth over the last year. Even on a smooth multi-year earnings for Amazon, the PEG ratio still came in at expensive 2.6 times. So I do like Amazon. I do own the stock, but a little bit expensive right now for new investors. The PEG ratio for Qualcomm also couldn't be calculated because it's expected to have negative earnings growth over the next 2 years. A few of the stocks I'm watching this week and the economic news that could guide the market. First up, GameStop, ticker GME. It's going to report its earnings on Wednesday, with investors really hoping it can break from that tight range below $28 a share. It's really been stuck at since last August. Investors seem to have just kind of lost interest in this lack of big returns here on this stock, but the company is expected to post a strong improvement in its earnings, losing just 12 cents a share versus 52 cents a share loss last year. Revenue isn't expected to improve this year. It's actually expected down 5.7% next year, so it could take something very optimistic in the outlook from management to turn these shares higher. We also see NIO, ticker NIO, is going to be reporting its earnings on Friday, with the EV maker really struggling in those price wars started by Tesla late last year. Now, NIO has largely decided just to keep its prices higher, not compete in that price war, possibly because it just can't compete with the ultra low-cost Boyd and is possibly on its battery switching technology as something kind of a price differentiator. Now, still, the shares do trade attractively priced here at just 1.86 times sales. That's a 74% annualized sales growth over the next 2 years, so very strong sales growth still expected and very cheap valuation here. Earnings are falling on increased sales or increased costs, so I would expect management to talk about cost cutting to improve that profitability during its report here on Friday. I'm also going to be very closely watching these retailer stocks. So here we see the Spider S&P Retail ETF, that fund of retail stocks, ticker XRT. Retail stocks were some of the hardest hit last week. Shares of Advanced Auto Parts down 45%, Ulta Beauty down 20%, even Nike down 15%, really on just that weakening consumer. It could be a sign of a broader slowdown in consumer spending that's really growing largely unnoticed by investors as the market hits those multi-month highs. The overall consumer discretionary sector is now up 7% in just a month, but only because the two largest companies, Tesla and Amazon, are up 20 and 26% over the period. Okay, without just these two stocks, without Tesla and Amazon in that consumer discretionary sector, the overall consumer sector would be down more than 3% for the month. Now, Strong's jobs report number and wages are supporting that consumer spending, but any crack in employment could cause spending to plunge even further. Here we see on the Spider sector tracker that all 11 stock sectors did close higher last week, though the safety sector, so utilities, consumer staples, did underperform as would be expected on that when that risk on appetite returns from stocks. Okay, when all stocks are rising, then investors tend to sell out of the safe sectors like utilities, like consumer staples. They rush for those growthier sectors like communication services, like technology. Even energy stocks closed higher last week despite the price of oil falling slightly for the week. It was interesting, though. I thought that stocks in the technology and communication services sector also kind of underperformed the general market, gains of just 1.3 and 1.6% on the week. Now, these sectors have led the market higher for the year, but might be giving up a little bit of that leadership as they become more expensive. Looking further out, and as we look at the year-to-date returns for each sector, while I still do expect more interest rate increases from the Fed, probably in July after a June pause, I would expect real estate and financials to start outperforming as we get closer to an eventual rate cut. You can see these two sectors, real estate down 1/3% this year so far, financials down 4% on that banking crisis. These two sectors have been the hardest hit by that rapid increase in interest rates and should bounce the other way when rates start heading lower. Okay, lower interest rates obviously are going to reduce the leverage and carrying costs in real estate, really helping to support those property valuations. Rate increases were the impetus. It's the reason why behind those plunging bank bond holdings and that banking crisis and just that reverse in interest rates should heal up the balance sheets for a lot of these financial institutions. Click on the link in the description below to get your free report, My Forever Stocks, the stocks I'm buying for the next 30 years. Or click on the video to the right for the 5 dividend stocks with 38% upside return potential. The best dividend stocks for price and cash return. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.